Over the past week, markets have been driven by a mix of economic data, corporate earnings, and evolving policy expectations. In this short update, we'll walk through a few key developments, highlight what's driving performance, and ultimately look ahead to what could shape the markets next week. Recent sharp sell-offs and large margin calls have triggered concern, but they've also historically marked turning points in the market. In fact, recent data shows de-risking and hedging activity hitting levels not seen since 2021. While uncomfortable, this kind of volatility often signals opportunity, not risk. When fear peaks, disciplined investors step in, and we believe that moment may be near. Despite the headlines, nearly 80% of S&P 500 companies have beaten earnings expectation this season. Forecasts had anticipated a decline, yet results are tracking flat or even slightly positive. This resilience is important. It reminds us that fundamentals are still strong and corporate balance sheets are holding up extremely well. Looking ahead, analysts are now forecasting over 18% earnings per share growth for the S&P 500 in 2025. A level seen only a handful of times in the past 35 years. In fact, historically, this kind of setup has been a powerful engine for market gains. As the narrative builds, we believe investors may start to re-engage in a much more meaningful way. There's been a lot of talk about the new US tariffs, but the actual impact remains yet to be seen. In fact, even if enacted, the proposed tariffs would affect less than 0.5% of US GDP. History has shown us time and time again that markets quickly adapt to trade policy changes. And so this time could certainly be no different. Markets are now pricing in a greater than 75% chance of at least one Fed rate cut before year end. This expectation is already providing support for both equities and fixed income. Lower rates help reduce borrowing costs, improve valuations, and create a much more constructive environment for risk assets. We've also seen a few clear drivers behind our recent performance. One of the strongest individual contributors has been United Health Group, which has delivered standout returns thanks to renewed regulatory clarity and ongoing strength in the managed care space. As a defensive growth leader, it benefits from scale, diversified revenue, and operational efficiency. And that combination has helped it shine in a market that's rotating into high-quality names. From a sector perspective, utilities have emerged as one of the best performing areas of the market so far this year. With rate expectations falling and investors looking for yield and stability, capital has flowed into this sector. Consistent cash flows and low volatility have all made utilities a valuable diversifier, and we've been well positioned to capture those tailwinds. And on a broader level, US equities continue to lead globally. Large cap companies with strong earnings, healthy balance sheets, and global presence are attracting renewed investor interest. Our exposure to these names across multiple sectors remains a key driver of outperformance across all of our strategies. The week ahead is packed with key data points that could shape both sentiment and strategy, offering valuable insight into the economic backdrop and potential opportunities. Canada's CPI report, due Wednesday, will give us a fresh insight into inflation trends north of the border. A continued drop could support future rate cuts by the Bank of Canada. US retail sales, released Monday, on the other hand, will shed light on the strength of the American consumer. Given that consumer spending represents approximately 70% of GDP, these numbers clearly matter. And finally, US big bank earnings kick off next week, with JP Morgan, Citi, and Wells Fargo all reporting. The tone, of course, that they set could certainly have a major impact across sectors. Strong earnings may signal broader economic resilience, especially in both credit and lending. And so despite the noise, the message is clear. Market fundamentals remain intact, earnings are surprising to the upside, and policy expectations are shifting in a much more supportive direction. We'll continue to stay focused, stay disciplined, and identify opportunity through volatility. Thanks for watching as always, and we look forward to seeing you next time.